Hi everyone, and welcome to Pensionmark's 2017 Q2 Quarterly Market Series. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A box on your console. At the end of the webinar, we'll take time to go through these together. Third, there are several widgets at the bottom of your screen, a contact us link for any plan or retirement-related questions, a refer a friend link, and a resource list which contains helpful documents and links for your reference. There, you can also find the slide deck of the presentation. Additionally, we will be doing polling questions throughout today's webinar. All results are anonymous, and we appreciate your participation. Now, I'd like to introduce Pensionmark's Director of Investments, Ronnie Cox. As the head of the investment research team, Ronnie is responsible for managing the investment research and analytics for the Pensionmark network. Ronnie has been with Pensionmark for 6 years and has worked with participants, employers, plan advisors, and economists. He graduated from the University of California at Santa Barbara with a bachelor's degree in business economics and a minor in technology management. Ronnie holds a Series 766 registrations and earned the Certified Fund Specialist and Chartered Retirement Plan Specialist designations. Thanks so much for presenting, Ronnie. Now I'll turn it over to you.
Thanks, Renata, and thanks to everyone that joined the call today. As Renata said, my name is Ronnie Cox. I'm the head of the investment research group here at Pensionmark, and today I wanted to spend some time to look back at what happened last quarter, both in the financial markets as well as the overall economy. From there, I wanted to give a brief outlook on what we're seeing ahead and then open it to any questions that you may have. So let's get started with the financial markets overview. And before we jump in, I want to mention we will have a couple polling questions sprinkled in throughout the webinar today. And we're going to start off with our first question here. Which asset class was the best performer in Q1 2017? Emerging markets, U.S. large cap equity, U.S. small cap equity, high yield bonds, or commodities. So click on your response and hit submit, and we'll get to the responses after. All right, it looks like we've got a good number of responses, so we'll go to the results. Looks like most people answered U.S. small cap equity. And looking at asset class returns for last quarter, emerging markets was actually the top performing asset class. But before we get into that, into emerging markets, I wanted to jump into domestic equity first. So, riding the momentum following the presidential election, stocks surged for much of the first quarter of 2017, buoyed by the anticipation of tax cuts and policies favorable to domestic business. The benchmark indexes listed here reached historic highs throughout the quarter. At the end of January, the Dow reached the 20,000 mark for the first time, while the tech-heavy NASDAQ gained almost 4.5% for the month. The trend continued into February as stocks posted solid monthly gains. The Dow closed the month with a run of 12 consecutive daily closings that reached all-time highs. And the S&P 500 also achieved a milestone of 50 consecutive trading sessions without a daily swing of 1% or more. At the close of trading in February, each of the benchmark indices listed here posted year-to-date gains led by the NASDAQ, which was up over 8%. March began with a bang but ended with a bit of a whimper. The Dow closed the first week of the month over 21,000, while the NASDAQ gained over 9% year-to-date. However, energy stocks flipped as the price of oil began to fall, and entering mid-March, investors exercised caution, pending the potential Fed interest rate hike and push for a new healthcare law. For the quarter, each of the indices listed here posted impressive gains over the fourth quarter closing values. The NASDAQ climbed the most, followed by the S&P 500, which achieved its largest quarterly gain in almost 2 years. On to fixed income. Long-term bond prices increased in the first quarter, with the yield on 10-year treasuries falling 6 basis points. For the second time in 3 months, the Federal Reserve increased its benchmark interest rate a quarter point amid rising confidence that the economy is poised for more robust growth. The move, which was widely anticipated by financial markets, takes the overnight federal funds rate to a target range of 0.75% to 1% and set the Fed on a likely path of regular rate hikes ahead. During the meeting, there was only one no vote from the Minneapolis Fed president, and for the quarter, the high-yield bond sector was the best performing sector, driven primarily by improved conditions in the energy industry. Lastly, to wrap up on the financial markets, I wanted to take a look at the international equity markets. A relatively positive stream of Eurozone economic data helped international stocks post gains for February. Both manufacturing service sectors accelerated during the month, while Eurozone job creation reached a 10-year high. In Great Britain, Prime Minister Theresa May continued to push forward with Brexit amid pushback from Parliament and protesters. Nevertheless, the UK delivered written notice to the President of the European Union, formally beginning the process of leaving the EU, also known as invoking Article 50. This action now opens up a 2-year window for Britain to negotiate the terms of its exit. One of the potentially contentious issues will be addressed is whether and how much Britain will pay to leave the bloc. In Japan, retail sales increased 1% for the month, although the fourth quarter GDP growth slowed from the previous quarter. Emerging market stocks advanced in the first 3 months of 2017, recording the strongest first quarter performance since 2012. Firming economic data in Asia and diminished concerns over potential U.S. trade policy helped lift emerging market equities. Emerging market currencies generally gained against the U.S. dollar over the quarter as waning confidence in the ability of the U.S. government to stimulate growth or impose trade sanctions led investors to adopt a weaker view on the U.S. dollar. Next up is our look at the U.S. economy, and this brings us to our second polling question of the day. Out of the last 11 economic expansions, where does our current economic expansion rank in terms of length? First, third, fifth, or seventh longest? We'll just give a few more seconds for responses. And looks like a majority of people responded third longest. And as a matter of fact, March 2017 marked the 93rd month of our current economic expansion, making it, in fact, the third longest expansion in the last 60 years. Since the current economic expansion has passed beyond 93 months now, and while the average economic expansion has averaged 47 months, many feel that we're heading towards a recession based on timing alone. While I understand concerns like these are reasonable after over 6 years of economic expansion, I do want to highlight the more gradual pace in which this expansion has moved, as shown by the light blue line in the chart on the right. Economic expansions have generally been getting longer as the service sector, which is a relatively more stable sector of the economy, makes up a higher percentage of GDP than the manufacturing sector. Its more stable growth may provide a more structural support for the continued economic expansion moving forward. Now looking at GDP, expansion of the U.S. economy slowed over the final 3 months of 2016. According to the Bureau of Economic Analysis, the fourth quarter 2016 GDP grew at an annualized rate of 2.1% compared to the third quarter GDP, which grew at an annual rate of 3.5%. Growth in GDP was slowed mainly by downturns in exports, federal government spending, and business investment. A positive from the report is the rise in consumer spending, which increased 3.5% over the prior quarter. An indicator of inflationary trends, the price index for gross domestic purchases increased 2% for the quarter compared to an increase of 1.5% in the quarter. And as to the government's budget, the federal deficit for February was $192 billion, and over the first 5 months of the fiscal year, the deficit sits at $385 billion, which is actually 0.7% below the same period last year. Next up is the employment situation. The economy continued to show strength as it added an average of 178,000 jobs per month last quarter. Job gains occurred in construction, private educational services, manufacturing, healthcare, and mining. The unemployment rate dipped to 4.5%, down from 5% a year earlier. There were 7.2 million identified as unemployed in March, and the labor participation rate inched up 0.1% to 63.0. The average work week was relatively unchanged at 34.3 hours in March compared to 34.4 a year earlier, and average hourly earnings increased to $26.14. Over the last 12 months, average hourly earnings have risen by 68 cents or 2.7%. And lastly, for the economic outlook, we look at the Consumer Price Index, or inflation. Inflation is measured by personal consumption expenditures reached the Fed's 2% target in February. For the 12 months ending in March, personal consumption expanded at a rate of 2.4%. Core PCE, which is your headline inflation minus energy and food prices, increased 2%. For the 2016 calendar year, personal income increased 3.6% from the 2015 annual level, compared with an increase of 4.4% in 2015. Disposable income, which is your income after taxes, increased 3.9% in 2016, compared with an increase of 3.8% in 2015. Personal income and spending data is going to be released on May 1st for data through March 2017. And if anyone has an interest in looking at that information when it's released, you can find that information on the Bureau of Labor Statistics site, which we provided in the resources widget on the screen. And for my final comments, I wanted to provide an outlook for the coming months and year. But before we get into that, I wanted to ask one last polling question. And this polling question may look familiar for those who attended the webinar last quarter. But we're asking how you feel about the outlook for the economy in 2017. Not confident, neutral, confident, or very confident. All right, it looks like we've got a good number of responses, so we'll go to the results. And it looks like most people responded with confident. So when I was reviewing the slide, trying to pick out themes for the coming year, I was looking at the previous quarter slide. And a lot of these themes, I think, remain the same. And there's one thing in particular that I did add to this slide, and that's geopolitical events. I think looking back last year, some of the biggest issues or themes to look out for throughout 2017 is the rise of populism with the Trump election. We saw the Dutch elections coming up. France and Germany are having elections later this year. Trade agreements were a big topic. Slow growth and inflation, deregulation, and the movement from monetary policy to fiscal policy. I think a lot of those all still hold this quarter looking forward. But what you're seeing a lot more this quarter is now geopolitical news. So, for instance, the bombing in Syria or the bomb that was dropped in Afghanistan, are tensions rising with North Korea and the relationship with China. So I think things like those pose macro risks and tend to weigh heavily on investors in their minds. But if we're looking at fundamentals and trying to assess your risk and risk tolerance, diversified approach is still the best route to go. With that said, I think the pro-growth prospects for 2017 are still a positive sign, though, as I said, it's not without risk. Increased political tensions, the potential for the administration to start a trade war, even though it seems as though following the meeting with China, Trump's relationship with President Xi in China is improving. But there's still a lot of uncertainty in the market, and that's something I think that investors should be aware of in addressing their portfolio in regards to. And so with that said, I wanted to end my comments with this slide, which will look familiar to those of you who attended last quarter. This slide represents the annual returns of various asset classes for the last 10 years, with the sample asset allocation denoted in the blue box with an orange star. While it's difficult for even the most experienced economists and market experts to predict how the markets will behave in the next 6 to 12 months, it's always important to keep in mind a long-term focus for your retirement plan. While the asset allocation displayed in the table has never been the top-performing asset class in the last 10 years, it's never been the worst performing either. Keeping an appropriate asset allocation based on your particular circumstances is an important factor to keep in mind with your retirement plan. And that wraps up my prepared comments, so we can go ahead and open it up to questions or not.
Yeah, thank you so much, Ronnie. We appreciate you sharing your time and knowledge here with everyone today. We'll start addressing some of the questions that have been filtering in. And please remember that if you have any questions, you can submit them using the Q&A tool on the console. As always, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions. So our first question here is, as an investor with at least 20 years time frame for retirement, how does this quarter's returns matter?
Thanks, Renata, and thanks for asking that question. That's actually a good question. And the short answer is any given particular quarter over a long time frame shouldn't hold that much weight in an investor's mind. As this questioner asked, a 20-year time frame is a long time, and so that's a lot of time to be spending in the market. And so I don't think that any investor with a long-term focus should be focused, positive or negative, on any particular quarter's return. I want to bring it back to the asset allocation theme, where the most important thing is making sure you're diversified and balanced based on your time frame and your risk tolerance, so that over time you're not experiencing these wide gains and losses that you might be if you were solely allocated in any individual asset class. So great question. We show that information here because we want to give a quarterly look back, just so people are more aware, particularly in what you see most in headlines and in the news. But overall, in the long term, you want to keep that focus and not shift towards a short-term focus. So great question.
Yeah, kind of going off of that, another question. What is the easiest way to ensure that I am diversified in my portfolio if I'm not a very experienced investor?
Excellent question. Again, what I would recommend is reaching out to the Financial Wellness Center here at Pensionmark. We've got a lot of great licensed representatives that can really educate and consult with you in terms of what your time horizon is, what your risk tolerance is, walk you through a questionnaire that really helps answer how you might allocate to be diversified, balanced, given your particular situation.
Thanks, Ronnie. And another question here regarding a retirement portfolio. If the economy stays stagnant, how can we make gains on our retirement portfolio so that we can fight inflation?
Excellent question. All very good questions. Again, I want to bring it back to asset allocation, and I hate to sound like a broken record, but if you look over long periods of time and you break that down into shorter periods where there's absolutely periods of stagnation, we saw last in 2015, it was very hard in a diversified portfolio to really outperform, and that's because a lot of the asset classes on an absolute basis really underperformed compared to previous years. But again, if you're taking a look at a long-term time horizon, and I'm going to pull back the asset allocation screen, that's going to be really your most consistent. And when you factor in emotions and how investors tend to think about losses and the pain that they feel with losses, bringing it back into a diversified portfolio really helps save you from yourself. So that just because there was maybe a bad year in the market or a flat year in the market, that you don't suddenly veer off course from your original plan, and that you stay focused on that long-term goal.
Great, thank you. Another question here. There is currently a lot of optimism in the market. How would you address those investors who want to take advantage of this rise by investing more aggressively?
Another good question. I think this is kind of the flip side of the previous question that was asked. And just like people are fearful when the market is flat or is in a loss, I think people get overly joyous when the market's really rallying. And so they tend to reallocate or invest based on emotion instead of fundamentals and really what's appropriate for them. And so while it may be appropriate in certain situations that you can allocate slightly more aggressive, and some people might think the opposite, that they want to capture in those gains and actually shift slightly more conservative, I think ultimately you want to keep in mind your particular situation, keep in mind the principles and the underlying ideas of why you were originally allocated that way, given your time horizon, given your risk tolerance. Because the last thing that you want to do is invest extremely aggressively because it's been a rising market, and if the market pulls back, you experience a significant loss, and then all that time spent you have to recapture. So bringing it again back to asset allocation, diversification, talk to your reps at the Pensionmark Financial Wellness Center, and they can help you with that asset allocation.
Great. I think we have one more question here. Actually a couple more. So in regards to how the U.S. markets performed versus other developed countries, what would you say are the driving factors that cause this disparity?
Well, I think the biggest difference is what a lot of people are calling the Trump rally in the U.S. So there was a lot of uncertainty leading up to the election before Trump was elected, and you saw market volatility get pretty shaky. Following the election, I think a lot of the industries and businesses were able to digest what had happened and look at what Trump was talking about during the campaign in terms of lower taxes, less regulation, and a really pro-growth environment for business. And so since the election, you've seen a pretty steady gain in the stock market because of this renewed optimism in a pro-growth administration, a pro-business administration. And so you've seen a lot of that, particularly in the last quarter of 2016 and the first quarter of this year. Now, a lot of that I think was driven on forward-looking optimism. Now we have to see if a lot of that stuff that Trump talked about during the campaign and since the election actually gets done. But I would say that was one of the bigger disparities in the U.S. stock market gains versus other countries.
Great, thank you, Ronnie. Last question here, and I'm not sure if this is referring to positive or negative, but maybe you could talk about both. What are the industries to watch?
Good question. I think I don't want to give any recommendations on, or I don't want this to be interpreted as industries to invest in or certain industries that I think are going to outperform other industries. But I think there's a lot of news or headlines. There's a lot of noise in a few industries right now. That would mainly be healthcare, with Congress and Trump trying to pass a repeal and replace of the Affordable Care Act. So there's, I think, going to be a lot of news surrounding that in the next 12 to 18 months, if a deal can get done or not. Oil, I think, is a big industry that there's a lot of news about because of the fluctuating oil prices that we've seen in 2015 and 2016, and this year. We've seen decreased regulation on the energy market or on the energy industry, and so that's something to watch out for. And also the financials industry. So there's a couple things with the Fed and how they approach raising interest rates over the next 12 months or throughout the rest of the year. Most economists believe that they're likely to raise at least 2 more times this year, so we'll see if that happens, and that could be potentially beneficial to the financial industry. Another is there's been talk in Congress about the repeal or modifying of the Dodd-Frank Act, as well as congressmen and senators have talked about introducing what they call a 21st Century Glass-Steagall Act. So a lot of these, depending on what actually happens, what gets through Congress, could have potentially beneficial or costly effects to the financial industry in particular. So I would say those 3 industries would be the top in terms of newsworthy, at least in 2017.
Great. Thank you so much, Ronnie. Looks like there's no more questions as of now. Please utilize the Contact Us button if anything comes up, plan-related or regarding the webinar. But for now, that'll conclude the webinar session. Thank you again, Ronnie, and thank you, attendees, for your participation. I hope everyone has a wonderful day, and we look forward to our next webinar series with you. Take care.